Welcome to Pro News Weekly. Let's dive into the latest updates from the financial markets. The US dollar is losing momentum. Stock indices are pulling back, gold has lost its edge, and Bitcoin is causing problems. The fall in oil prices is gradually easing inflationary concerns. The resulting decline in Treasury yields halted the US dollar's rise at the end of the week. In the futures market, expectations regarding monetary policy have been revised downwards, with 2 interest rate hikes this year, now considered unlikely. Competitors are gradually regaining their footing. The euro attempted to stabilize following a statement by Isabel Schnabel that the ECB must continue to increase rates. The yen was supported by a speech from Bank of Japan official Naoki Tamura. He stated that the overnight rate must be brought swiftly to a neutral level of 2%, with monetary policy tightening every few months. The S&P 500 has been on a downward trend since the 16th of June, due to concerns over Fed rate hikes and a sell-off in technology companies. Investors are skeptical that the massive investments in artificial intelligence will pay off. The need for massive investment has made the stock market increasingly dependent on sentiment surrounding the key interest rate in recent years. Also, competition is forcing companies to lower their service prices. Meanwhile, their current blockbuster earnings result from spreading their costs across quarters. Morgan Stanley compares the current period to a golden window, when everything looks good. Still, this will not always be the case. Even so, Wall Street remains bullish on the US stock market. JP Morgan has raised its year-end forecast for the S&P 500 from 7,600 to 7,800. The firm points to an upward revision of the consensus earnings estimate. Such significant revisions have occurred only after the US economy's recovery from recessions or shocks. Midweek, the S&P 500 touched its 50-day moving average before rebounding, suggesting bullish sentiment is prevailing in the medium term. Gold dropped below $4,000 per ounce, as the Fed's hawkish shift stripped it of its key advantage, the so-called debasement trade. Between 2025 and 2026, the precious metal rose on expectations of massive monetary expansion. This reduced the appeal of fiat currencies. Now, by contrast, interest rate hikes are expected. This is leading to capital outflows from ETFs. Since the end of February, their holdings have fallen by $12 billion. This is the worst performance in 4 months since 2013. At the same time, central banks are revising their gold forecasts downwards. Goldman Sachs now sees it at $4,900 instead of $5,400, whilst Deutsche Bank has slashed its forecast by 22%. Bitcoin briefly fell below 60,000 and continues to trade near its lowest levels since the fall of 2024. Investors have withdrawn around $6 billion from specialized exchange-traded funds. The flow of capital into other markets, the inability of cryptocurrencies to act as a hedge against geopolitical risks, and problems faced by the largest buyer of tokens are increasing the likelihood of a continued decline in Bitcoin. Investors are losing confidence in crypto custodians. Industry pioneer Strategy has incurred $11 billion in losses, and the company's business model is on the brink of collapse due to Bitcoin's fall of more than 40% from its record highs. The key event of the week leading up to the 2nd of July will be the release of U.S. labor market data. At the end of 2025, the cooling of the labor market provided the basis for the Fed to cut interest rates. In early 2026, the stabilization of employment growth allowed the central bank to set a course for maintaining borrowing costs. The labor market's best performance in 3 years, recorded this spring, has sparked talk of a monetary policy tightening. What will happen this time? Other key events to watch include reports on German and European inflation, as well as the release of ISM data on U.S. manufacturing business activity. Keep up to date with the latest developments on global markets with Pro News Weekly. Like, share, and subscribe.